All right, hello everyone. Tonight we are going to be talking about orbs and how to trade the FOMC. This lecture is a little bit shorter, but it's kind of short and sweet to the point. So I don't really want to make it any longer than it has to be. So let's just jump right into it. So it's probably no secret that traders love to trade the open. Why is that? Trading the open is where you'll get the most opportunities. So some of the pros is we always get that volatility, getting that push up or that push down. So most of the action is actually occurring at the open. That's when the big money players are making their trades. That's when they're buying. That's when they're selling. So it's just kind of just a huge rush of activity at the open. So with that is going to come additional volume. So there's always going to be the most open at or the most volume at the open. And as price action traders, we know that volume is going to be what's required for that initial, that extra push that validates our setups. And we can use the open to gauge the sentiment. So we can see how eager the buyers are. We can see how uneager buyers are. We can see how eager the sellers are. We can see if there's chop or if it's extremely volatile. Now, it doesn't come without its dangers. And when I'm talking about the open, guys, I'm talking about the first 1 to 2 hours. Ideally, I like the first hour, but the second hour is good too. Once you start getting into the first 3 hours, then you kind of miss the meat of the move. But there's usually almost always a setup at the open. Not always. And that is another con. But the first con is that it can be extremely dangerous. So if you don't know what you're doing, if you don't know how to play the volatility, that volatility can actually be extremely dangerous. So when you have these huge 20, 30 point candles whipping every which direction, you can get chopped up, death by 1,000 paper cuts. It's not something you really want to do all the time and get stopped out quite frequently. There's not always going to be a setup. Sometimes that's just how it is. And you're going to have to wait for a break at the 30-minute range or some kind of setup in the late afternoon. But that's okay. We don't have to trade every day. If we don't see a setup, so be it. We'll just log off. And then, of course, it can be easy to get faked out. It's happened to me a million times where I go long at the open, and then I'm immediately met with huge bearish candle. So it's not fun. Not fun at all. So when you trade the open, I trade with a little bit less size so that I can account for all that extra volatility. So I'm not making my stop too tight. And that if I do get stopped out, I'm not going to take a huge loss. So there's a lot of things that the opening range tells us. So what the opening range is going to tell us is going to be an indication of the sentiment for the day. So it'll show us how strong or how weak the buyers are, or how, vice versa. How strong are the sellers? How strong are the buyers? How weak is the market? Or is there going to be sideways action? So here on the right, you can see that there's a very weak open. You see these extremely bearish candles. So when you have that opening range that is pretty bearish, it's telling us that we may be in for a very bearish day. And based on the size and the volatility of the opening range, we can kind of gauge what is the potential volatility for the day. So as traders, we need volatility to trade, but we don't want too much. We don't want 200-point NASDAQ candles, because if we get stopped out, that's just going to be way too much heat on the trade. So for example, if the E-mini only has, a 5-point range in the opening 10 to 15 minutes, that shows us that sentiment isn't really that strong in either direction. And we're probably not going to get involved. So when we see sideways open, It's not something we want to get involved in. We want to wait for a better opportunity. So trading open is all about patience and all about seizing the moment. So if there is momentum and volatility, and then you see that A plus setup, you got to be quick and you got to jump on it. But if there's not, you have to practice restraint and make that decision not to take a trade. So it's easy to take a trade, but it's harder to not take a trade. And then vice versa, if the ES has an extremely wide opening range, 20, 30-point candles, then that volatility can be extremely dangerous. That's not something you want to get whipped around in, especially if you have like a smaller account. So I've prepared a couple of examples here. So see here on the left, we've just got that push right out of the gate, right from the jump. Buyers are strong. We've got these very clean, very nice bullish candles. We've got 3-bar play here. Similarly, for a weak open, we've got these very clean, very full, solid, bearish bars. Okay. So, and that's the thing, guys. When you get that push or that drop in the open, you want clean action. So you don't want anything like this. So this is the sideways open. And so you see how it's just in a very tight range. Maybe it's 4 or 5 points, not really doing all that much, right? So maybe SPY is stuck between 2 key levels, or we're in a consolidation day. There's nothing to trade off of here. So, forget about it. There's nothing you want to get involved in. And then we have the opposite of that. And this is also a sideways open, but is extremely volatile. These are massive candles. So you're going to try to take a break in either direction. You are just going to get faked out. So we want to wait for something clean. See these candles? These are clean. This is a hot mess. You don't want to get involved in these massive whipsaw ranges or in these tight sideways ranges. So like I said, we don't want too much volatility, but we need some volatility. So you want to go for these. That's why they have check marks and these have X's. Bueno, no bueno. So here's an example. You see this opening range? So this is just a absolute mess. So there's nothing to really trade here. And I'm sure people say, well, what about if you scalp? The odds really just aren't in your favor. See just how much price is just whipping around. It's not really anything you want to get involved in. So that's why I put this box around here. So you want to wait for a break out of the box, and then maybe you could find some kind of trade in that regard. But as long as you're stuck in the first 30-minute range, refrain. Don't do anything yet. So typically, I'm not going to buy or sell or take any trades in the first 5 to 10 minutes, maybe even 15, until I see something that lets me know where is the sentiment for the day. Are we chopping? Are we going to be in a trend day? And sometimes you don't even know that until after the 30-minute range. So I'm not going to say, oh, it has to be this increment of time. That's the opening range. It has to be a 10-minute, 15-minute, 30-minute, 1 hour. I wouldn't do 1 hour because then you would have missed a good majority of the move already. So the good moves, they're going to happen at open. So I think 10 to 15 and then 30-minute, depending on the situation, because every day is going to be different, have different price action. So here we have very large bodied candles, very large wicks. Not anything you want to get involved with, especially if you're trading options. You are going to get destroyed. And then look at this chop day. Just very small range, it's like a 10 or 15 point range on the E-mini ES. And there's really not any volatility to trade off of. There's no volume. So avoid that kind of opening range as well. What you want is something strong like this. So, you get that strong push right from the jump. You're over the pre-market resistance. You're over the previous day high. And so Then you can look to play what we call an opening range breakout. And then similarly for a bearish scenario, it's not shown here, but we broke below the pre-market low. And then we get these bearish candles right from the jump. Clean action, clean candles, small, no volatility, huge, too much volatility. So understand the difference. So use that opening range to kind of ask yourself, where are we within the context of the chart? What is the action looking like right now? So let's talk about the 10-minute orb. This is one of my favorite strategies. This is one of my bread and butter setups. So what does ORB stand for? It stands for opening range breakout. So what does that mean? So we're going to mark our opening range high and our opening range low. So when the market opens, doesn't matter what market you open, whether you trade the London Open or the New York Stock Exchange, but for all intents and purposes, let's talk about stock exchange. So when the stock exchange opens up, the New York Stock Exchange opens up at 9:30 a.m. New York time, we're going to take our first two 5-minute candles and we're going to draw a line. We're going to mark our opening range high. So this is the high of the range. And we're going to mark our low of the range. And then this is really simple, guys. This is like the easiest strategy I can literally teach you. When it goes above the opening range high, you go long. Okay? When it goes above the opening range high, I mean, then you can go long. You can buy calls, contracts, whatever. And then, same for the bear scenario. So if it went below the opening range low, then you go short. So what the opening range is going to tell us, not only, what is the sentiment or potential action for the day, potential volatility, this opening range can actually potentially act as support and resistance throughout the day. So we could look for retracements, retests of the opening range high. If you're going short, look for a retest of the opening range low. Basically, you want to take trades outside of the opening range. You don't want to be stuck in this range, taking trades in the range. You want to be out in either which direction. Okay, that sounds great and all, but you'll go back and you'll back test and you say, hey man, this strategy kind of sucks. How can I increase my chance of success? So what you really want, you want a gap below or above. So look for stocks that have gapped. So you can go to your Webull watch list or your TOS watch list and then scan the pre-market gainers and losers. Remember we talked about the 3-bar plays? The orb is extremely similar. So you want something that's getting action, something that has strong volume in pre-market, something that has maybe news. But basically for this bearish orb, we're on the NQ 5 minutes. QQQ is the same chart. We get a gap below the previous day's low. We get a gap below the support. So that's going to add to the selling pressure. So what we do, we take our opening range high and our opening range low. So this is the first two 5-minute candles, mark the high, mark the low. And then when you go below the low, then you go short. And then you put your stop maybe above this swing high, maybe above the high of the open, depending on your size and then your tolerance. Because if you're playing options on the Qs, that might be a little bit wide. I think above this candle would have been fine. And then what do we do then? So there's a number of ways that we can take profits. And what I like to do, you can trail your profits with market structure. So price is continually making lower highs and lower lows, lower highs and lower lows, lower highs, lower lows until the close. You actually could have held until the close. Now, me personally, I don't know. I don't really have the patience to sit in front of the screen all day and watch that. So here's another strategy. You can actually apply a 9 and a 21 EMA. So we are on the 5 minute. So your 5 minute, 9 EMA and 21 EMA are going to serve you well in these kinds of situations because the 9 EMA is the short-term trend. So if price is really trending and it is a strong trend, it's going to respect this 9 EMA. And then our 21 EMA, that's going to be our medium to moderate term trend. So super easy. So you take the orb, and then what? You're good to hold as long as the 9 EMA holds. So as long as a candle does not close above the 9 EMA, you're good to hold. So see how it went and wicked into above the 9 EMA? That's okay because it never closed above the 9 EMA. When it closes above the 9 EMA here, then you can take your profits. Or another strategy you can use is you can take half off when price closes above the 9 EMA and then maybe hold out until when price closes above the 21 EMA. Then you could have also used your context clues. Like here, it looks like it's flagging into the 21 EMA. So maybe wouldn't have been as quick to let go. And it depends. Are you trading futures where there's no theta decay, where you can actually hold all day with no consequences? Or are you trading shorter dated options? You're trading SPX or SPY puts that expire at the end of the day. If you're trading options like that, especially the shorter dated ones, I would just do the 9 EMA close because you don't want to get caught in the lunch chop and then have theta destroy the value of your contracts when you actually did make a good trade. So be sensible. When you're trading options, you just want to play that opening push. Now, if you have options maybe like a month or two out, yeah, go ahead. Feel free to hold for all day or all week, as long as you are following what the chart is telling you or price is guiding you. All right, so back to this example. This is our Home Depot chart, HD. This is a 5 minute chart. And what I like to do is use 5 minute charts. You can use 3 minute charts. You can use a single 15-minute chart. It doesn't matter. It's basically what the opening range is. It doesn't have to be in time increments. It's basically where you put in a high and a low. So I think when price starts to retrace a little bit, then you'll have a place to kind of anchor your orb. It doesn't have to be time-based. Well, here, this example I made a long time ago, February 22nd. Here, I just did a time-based one. So this is the high, this is the low of the opening 10-minute range. And then when it goes below, you can short. Here, you could have, it made a lower low here. So you could have drawn your Fibonacci, taken this 50% retracement and went short there. Or you could have went short right here and then put your stop somewhere above here, maybe 50% of the candle. And then see, we got this moving average right here. This is the 9 EMA. As long as you're below that, you're good to hold. If you are trading options, definitely take some off the table. If you're up 50, 60%, sell a couple here, sell a couple there, and then eventually you're just having only runners on the table. Now you can do that with futures too, but futures, you don't have theta decay, so you don't have to get scared out of your trade so easily. So it's not as simple as just when it goes above this line, buy calls. When it goes below this line, buy puts. No, you want to look at your context clues and where you are within the chart. So these are 3 requirements. So number 1, look for a strong gap in the pre-market. So what has news? What has volatility? What's got volume? Where's the mob? And what is the mob? Those are the majority of buyers. What are they looking to play today? What is big money got their eyes on? And you rarely want to take orbs in the prior day's range. So see here how we gapped below the previous day's low. We're not in the previous day's range. And here we're above the previous day's high. So I typically don't want to take trades in the previous day's range. So as day traders, we want to mark our previous day high and our previous day low. because those can act as support and resistance, or kind of points where they push or pull away from. And then it has to be off of a key level. So you don't want to take the orb every single day, because that's just terrible strategy. They're going to work best when they're reacting to a key level. Are they bouncing off support? Are they breaking support? Are you rejecting resistance? Are you breaking above resistance? So they're only going to work when there's liquidity in that area, when you're at a major make or break point in the chart. Does it make sense? And then look for price to break the pre-market support and resistance. And only if there's clean action. Remember that we talked about the chop and the sideways action. Don't trade it if that's what the action is looking like. So only if there's clean candles and you're breaking that pre-market high or below the pre-market low. And or it could be you're breaking a trend line. All right, so let's look at another example. So this is the Microsoft 5-minute chart. So we have the prior day low. And so we actually gapped below. See this gap in pre-market? The shaded area, that's all pre-market action. So we gapped below. So we know that the wind is with us. So we're going to be looking for sells. So the gravity is working against the buyer. So we're going to be looking for sells. So we're going to be either looking for that 3-bar play or that orb opportunity. So we have our pre-market high, our pre-market low. And so we actually open with a big green candle and then immediately engulf the opening 5-minute candle. And so our opening range is actually a bearish engulfing candle. So you could have went short there. And that actually coincides with the pre-market low. So when you have that, you can go short right there, or you can wait for the retracement, or you can add at the retracement, see how it pulled back. So if I draw my Fibonacci from this swing high to this swing low, we're going to reject the 0.382 retracement. That's a 38% retracement of the move. And then what do we do then? Then we aim for the negative 0.236. So that was an amazing trade we took. Very simple, very easy. So you don't have to necessarily get scared when it retraces. You could actually be looking to add to your positions. All right, so we've got another example. So this is the Microsoft chart again. So we've got the open below the previous day's low. So this is our first 15-minute range. As you can see, these candles are kind of wide. It's kind of a big old range. So when the range is really big like that, I'm not really looking to get involved, because I don't want to get whipped around, especially if I'm trading options. Be down 50, 60% in a few seconds. Not my style. So I'd rather wait for kind of a trend to establish than enter on the retracement. So we did eventually break below the orb, but then I'm going to wait for the retracement. And see, here we have this fair value gap from the wick of this candle to the high of this wick. So we have not only a fair value gap, but we're also in the 38% retracement. And when a stock is respecting the 38 retracement, that means that the trend is pretty strong. So we could have taken this as a scalp, aimed for the 0 line, or if we had longer dated contracts, we could have held until it eventually did hit the negative 0.236. So when the opening range is wide like that, I'm not really looking to get involved, because it's not very clean. Huge wicks on both ends. That's something I'm really getting involved with. Now this is pretty clean. So it doesn't have to be in the first 15 minutes, because that opening range high and that pre-market high, those are going to pretty much act as support and resistance throughout the entire day. So here, this happened a little bit later. 5, 10, 15, 20, 25, 30, 35, 40, maybe like an hour and a half into the day. But you can still play it the same way you play an orb. So it breaks the pre-market resistance, but not only that, it breaks the opening range high. So this is the opening range high. And then it breaks through that. We have a higher low. So we have somewhat of an ascending triangle into the pre-market resistance and the orb high. So that's kind of a no-brainer trade for me. And then you can just put your stop loss right under the swing low. And I love plays where there's a very obvious swing low that's not too far away that I can kind of quantify my risk. Sometimes with the orb, it's kind of hard to know where to put your stop loss. So you either wait for the retest, the retracement, wait for a swing low or swing high to be formed, and then you can kind of take it. And I see here we have this accelerated volume. So that's going to help us kind of read the chart, say, hey, looks like buyers are kind of stepping on the gas here. I think I'll go long on the break of this resistance. Yeah, and then you can trail with the higher highs, higher lows. So we got higher high, higher lows, higher highs, higher lows. No reason to sell. No reason to sell. You could have held until the close. And I know that's easier to say in hindsight, but if you observe the market structure, that's going to help you stay in trades longer, because I feel like that's a problem that a lot of people have. They're not holding their trades as long as they could be. You know, we're not trying to catch every top or every single bottom, but we do want to let our trades run and get the most bang for our buck. You know, if we're putting thousands of dollars on the line, we want to make money. You know, we're not here to make a couple pennies. We want to make actual substantial income off of our trading endeavors. So here's another example. So this is a pre-market high in the S&P 500 E-mini futures. I mean, in futures, you don't really call it pre-market, but you know, for the purpose of this, might as well call it pre-market. I mean, it's the Globex session, the overnight session. This was the high. We've got some clear resistance. We break above it. We tap back into the FVG, so that could have been an entry. See, we broke structure. We made a higher high. We made a higher high. And then we tap back into FVG. Boom, we go long. The rest is history. Now, here's another scenario. When you break below, when you gap below the previous day close, but then you actually fill that gap. And so that is actually trapping the people who went short at the close. Eventually, they're going to have to stop out or let go of their positions. And what do you have to do when you cover? You actually have to buy the contract. You have to buy the stock. So that's actually going to add fuel to the buying pressure. And so that actually makes for a good orb. So you can actually look for them in either direction of the gap. All that matters is that there is a gap. And of course, this is our 3-bar play. You just go high above the high of the opening range, and then boom, you aim for 2R, 3R, whatever your preference is, whatever you back tested. You can use the 9 EMA. You can trail with swing highs and swing lows. You're going to have to experiment. I can't tell you what is the correct way to take profits, because it's going to vary for everyone. So if you only like to trade the first hour, maybe the 9 EMA work fine for you. Maybe 2R, 3R works fine for you. But just try not to chicken out of your trades before they hit their target. And whatever you do end up deciding, keep it consistent. All right, here we got another example. It's the Netflix 3-minute chart. So if I really, kind of like the setup, I'm not always going to use 5-minute candles. Sometimes will use a 3-minute. I don't recommend using like 1 or 2 minutes, but 3-minute, it's a little riskier, but it is going to get you in the trade a little bit earlier. So you have to decide. So, the first 10-minute range is just absolutely huge. Then you're kind of chasing at that point, right? So when the setup is just A+, I'm going to use a 3-minute orb. So here we gapped above prior to close, and then we've got this pre-market high, and that coincides with the high of our orb. Boom, we go long, and then applied a 9-period moving average. And then when it closes below, that's when you take your profits. But since you're dealing with options, take some off here, take some off here, sell, every 30, 40%, take some off the table. You don't want to let this trade go red on you. Because when you're, over here throughout the day, theta is going to kick in, especially if it's like Thursday afternoon, Friday morning, when you've got those really short dated expirations. Then you got to trim. You got to trim on the way up. All right, so we've got NVIDIA 5-minute chart. So this is an example from the 3-bar play lecture, but it actually works because the 3-bar play a lot of the time is an orb. So an orb can be a 3-bar play. A 3-bar play isn't necessarily an orb, but they work extremely similar. You want a gap below the previous day close. And then you break that pre-market low. And then you also got that bearish 921 EMA cross. And then, kind of a no-brainer trade. I mean, we were still in the previous day's range, so maybe I would have not gone so big in that trade. But it's a great example nonetheless. And then when you close above, you get that candle close above the 90 EMA, then you can take your profits. So it can be scary when you're in a trade and you're up a massive amount and you're thinking to yourself, man, I really don't want to let this go against me. Versus I want to hold for more as much as I can. So you have to meet in the middle. You don't want to be greedy, but you don't want to be a baby. You don't want to be a chicken, chicken paper hander, a chicken hander. So you want to get the most out of your money. So no reason to exit. Absolutely no reason to exit as long as you're below the 9 EMA. That's my opinion. So you would never let a huge move like this go against you. You let it go all the way back up here. That would be stupid. All right. So we just got one more thing, and that is how to trade the FOMC. So what is the FOMC? It's something that happens quite frequently. It's a Fed meeting, and they talk about rates and all kinds of treasury stuff. I'm not going to get into that. It's all kind of super complicated. But you don't need to understand any of that to make money off of it. So this is going to work for the SPY, the NASDAQ, the QQQ, the NQ, the ES. Could even work on the RTY or IWM, but I like the S&P and the NAS better. And so the FOMC, excuse me, it is going to have an extremely volatile, extremely wide range. Now, it is risky to trade it, but if you actually know what you're doing, you can actually make a ton of money on these setups. And that's why I'm putting in this course. So you always want to be aware of, what is the economic data coming out? When is CPI? When is FOMC? When is PPI? Because the market is going to react to them. So while we react to price action and technicals, the big money players, they're reacting to macro environment, economics, interest rates, what the Fed is talking about. So whatever they say, the market is going to have a huge reaction. But I figured out a way to play it. So that day of the FOMC, it usually happens at like 2 p.m. I think that's right. Usually 2 p.m. New York time. You don't want to trade at all until after the announcement. So it's usually just going to be chopped. Even the day before, it's probably going to be choppy. You don't even want to trade that. But wait for the announcement. Okay. And then don't do anything. You're just going to watch. So wait for 30 minutes after the announcement. So this is our FOMC range. This is when the announcement happened. And so as you can see, we've got a pretty volatile range compared to, look at these baby candles from over here. So here the market was just waiting for the reaction. And then here we get the reaction. We get tons of volume, tons of action. But if you would have just, placed any which order, you would have gotten burned. You would have gotten smoked. So what you want to do, apply the same strategy as the orb. So mark your high and your low of your 30-minute range. Now, does it have to be a 30-minute range? Not really. All that matters is that a high and a low have been established. And so you don't want to trade anywhere in here. And you're just going to take the same strategy as the orb. So you just go long when it breaks above and then sell. You either hold to the close or when the 9 EMA breaks on the 5 minute. So usually the first move is a fake out. So we had the initial thrust and then we had this huge bearish candle. And a lot of people are thinking, let's go short. I think the market's about to dump. And then took out all those guys with the, just no mercy at all. And then massive Maribozu candle. So this can actually make you a ton of money if you play it like the orb. Now, I don't recommend you swing because a lot of the times we'll see this huge pump after the FOMC and then it'll dump the next day. So don't swing, either hold to the close or use the 9 EMA strategy. So like I said, this is extremely risky. I wouldn't go huge on these trades, but they can be extremely profitable if you nail the direction. Now, I only have 2 examples because my charting services, they only let me go so far. Yeah, on the 5-minute charts. I could only get back to, I think, July 6th or July 7th. So I only have 2 points of information for you. But that's okay because it perfectly explains my point. See, we were just chopping around here, not really much volatility. Look at the size of these candles. Just completely, I mean, there was, a little bit of movement at the open. But then here towards the afternoon, everyone's just waiting for FOMC. So mark high, mark the low, and then take the orb, basically. So the same way we play the orb is how we play FOMC. Now I think this is important to learn because these happen, I think, once a month, something like that. So here's another example. So this is when the FOMC announcement came out. So we had this massive range. See, the market is reacting. And then we got that huge down candle, and then we're just kind of chopping around. All right, so mark your range high and your range low, and then take the breakout. So here, this actually broke out above the opening range high, and then retested. So that could have been a second potential entry. And yeah, and then close when it closes below the 9 EMA. Take your profits. So every situation is going to be different. Sometimes you'll get the retest. Typically with FOMC, I don't think you get the retest. Whatever way it decides to go, it's just going to go, right? And then when you wait for the retest, that's what happens at 2 o'clock. So you're waiting for the retest. It might be too close to the close to take a trade. Like, see right here, this is probably like a 50% retracement in this fair value gap. Probably wouldn't have taken this because that is just so close to the close. And then it just chopped around. Maybe I would have, I don't know. But as you can see, it just chopped around to the close. This is that dotted line. So what is your assignment? I want you to find 10 examples of the orb that check off all the requirements. Did you gap up or below? Are you bouncing off a key level? Are you rejecting a key level? Do you have clean action? So it can be your first 10-minute range. It can be your 30-minute range. And remember, if you're stuck in the 30-minute range, you don't want to take a trade. So if it breaks above the 10-minute orb and then fails and then comes back in the range for the first 30 minutes, then stay out of the market. Okay. And then I want you to paper trade these. Don't risk real money yet, but paper trade them. Look for those leaders or those losers. Now the drawback with the orb when we're talking about futures, if you only trade ES or if you only trade the NASDAQ, these aren't going to happen as often. But if you trade relative strength, this is kind of be what you're looking for at the open. And then kind of decide, what is your exit strategy? You're going to trail using market structure, or you're going to use a 9 EMA, 50 EMA, I don't recommend that. You recommend the 9 or the 21 EMA, or are you going to go for 2R? Are you going to go for 3R? Risk 100 to make 300. It was really up to you. I can't tell you what you should do. Because good strategies are built, they're not found. So I can teach you the strategies, but you have to build them around your personality, what you want to do, how your personality manifests itself through your trading activity. And so I will upload that to the Google Classroom. And then we have a couple more lectures. One is on 1, 2, 3 setups. And then the other, I think, is on supply and demand. So thank you so much and have a good night.